Hello, good morning. Wishing everyone a very prosperous and happy new year. I am Avnish Jain. Let's look at what happened in debt markets in the last month of 2023. Usually December is a quiet month because of holidays. However, this time it was different. This time Fed delivered a surprise in form of a pivot when Governor Powell talked about discussing rate cuts in the Federal Open Market Committee or the FOMC. This is first time it happened in past 3 years, because in the last 3 years we have seen a relentless rise in rates. The markets went into a tizzy. Yields dropped. We saw yields which had topped 5% just a couple of months back, dropping to 3.8% by end of December. Other markets like equity markets also rallied, and dollar weakened against the major currencies. The reason for the pivot was because now the soft landing narrative is becoming a more probable event, with falling and sustainable inflation in US, as well as growth has moderated to a considerable extent. Now expectations are of US Fed able to bring inflation down to the target rate of 2%, while growth may just moderate a little without going into a recessionary trend. Elsewhere, the European Union also inflation came down, but growth is coming down faster, and it is expected that the ECB or the European Central Bank is likely to deliver rate cuts much before Fed may do. China continues to be a slow economy, and they are unable to really reinvigorate growth in their country. Coming to India, India continues to be in the spotlight. Growth continues to remain robust, though there are certain indicators, especially forward-looking indicators, showing some slowdown in manufacturing output. Inflation has come down, but still remains above 5%, which may be a little worrisome for the RBI. Overall, rate markets continue to remain sideways, and that is what happened in December. Though because of large fall in US rates, we did see Indian 10-year also come down, though not very much. Markets have been range-bound because of higher inflation expectation in near term in India, as well as tighter liquidity, which has been there for last 2-3 months. Liquidity deficit crossed 2 lakh crores in December, one of the highest seen in the near term. Liquidity has been easing a bit in early part of January, but we expect that liquidity deficit to remain tight, as RBI seems to be following a policy of keeping liquidity tight to at least bring down inflation below 5% or around 5% in the medium term. We do not anticipate RBI to reduce rates immediately. RBI may reduce rates post-Fed rate cut, which is probably in first quarter of FY25, that is April to June, April 24. Overall, we expect 50 basis of rate cuts being delivered by RBI in FY25. While expectation in the US is almost 100 basis of rate cut because of higher inflation in India, and also the growth is pretty good, RBI is unlikely to be very aggressive in its rate easing cycle. They will look at local conditions to determine the level of rate cuts. Flows in Indian markets, especially debt markets, have been very good in last year. This is first time in last 6 years we saw large inflows in debt markets from FIIs. Almost $8.2 billion of flows happened in calendar of 2023, out of which $4.2 billion came in the last 2-3 months itself. This is probably due to the expected inclusion of Indian government bonds in the JP Morgan Emerging Bond Index, which starts in June of 24. This will bring in estimated almost 20 to 25 billions of inflow in FY25, and probably FIs are trying to front run these inflows, and active funds are taking positions ahead of this inclusion. That's why rates have been fairly flattish to downward bias, and we expect the trend to continue in near term. However, liquidity remains deficit, and that will continue to put pressure on the short term of the yield curve. Borrowing by states have risen in the last quarter, and that also have impacted markets in the near term. Overall, we expect FY25 to be a better year for bonds. One, because the rate easing cycle would have started in the US and probably RBI would be looking at a few steps of rate easing as well. Second, because of expected inclusion in the JP Morgan bond index, flows are likely to start coming in a big way in first quarter of FY25. That will support bond markets and 10-year yield could go below 7% by that point of time. Since currently the rates are on the higher side, for the investor who has medium risk capacity, banking PSU debt fund is a good option for investments. Investors who have high risk capabilities can choose to invest in gilt funds, as we do expect a larger rally to happen in government bonds because of inclusion in the JP Morgan bond index. As usual, investors should continue to exercise restraint and invest according to their risk return capability. Thank you and goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.